California's luxury housing market is undergoing a repricing event unprecedented in its modern economic history. For decades, the narrative around high-end California real estate was structurally bullish. Limitless demand, constrained supply, perpetual price appreciation, and a global buyer pool willing to absorb rising costs. That thesis is now collapsing. The shift is not cyclical, it is structural, and structural declines do not rebound quickly. Across several core luxury markets, including Calabasas, Beverly Hills, Malibu, San Francisco, Napa, Santa Barbara, Laguna Beach, Palo Alto, Palos Verdes, and Greater Los Angeles, properties that once traded at $3 to $6 million valuations are being repositioned at discounts ranging from 25% to over 50% while still failing to attract liquidity. Many of these markets now exhibit a pattern analysts refer to as locked-up premium inventory, assets that remain cosmetically pristine but financially toxic. The underlying issue is not aesthetics, desirability, or demand for California's lifestyle branding. The underlying issue is risk repricing. Risk has become the dominant factor in valuation, overshadowing square footage, location, school districts, and architectural appeal. Insurance, wildfire exposure, flood risk, expensive regulatory regimes, infrastructure fragility, HOA costs, utility volatility, and seismic vulnerability all contribute to an ownership landscape dramatically different from what existed during the low-interest, low-risk era of 2011-2019. The following report is structured as a professional analysis of 10 California cities where luxury valuations are undergoing accelerated repricing. This is not a consumer-facing narrative. It is a financial autopsy of a market equal parts dysfunctional and overleveraged. 10. Calabasas, the wildfire exposure. Premium Calabasas historically represented the aspirational standard for gated luxury in Los Angeles County. From 2016-2021, this submarket displayed price elasticity consistent with reinforced demand from entertainment professionals, high-income remote workers, and foreign capital. That thesis is now inverted. Market indicators, days on market for homes above 2.5 million exceed 160 days depending on the subdivision. High-risk wildfire corridors, formerly a soft negative, have become a hard underwriting constraint. Insurance carriers have retracted coverage or imposed severe premium escalation. Key structural issue, insurance fragility. California's insurance market is undergoing an actuarial correction. Premiums previously considered excessive, e.g., $6,000, $9,000 annually, now appear modest relative to today's norms, where quotes exceeding $20,000, $40,000 annually are increasingly common. Some homes are forced into the California FAIR Plan, which provides limited fire coverage and excludes essential perils, forcing buyers to layer supplemental policies. Ownership cost breakdown, premiums up 80 to 100% over 5 years. HOAs impose strict compliance rules that increase annual carrying costs. Maintenance for older estates has risen as materials, labor, and water continue escalating. Investment impact Calabasas is transitioning from a luxury aspirational market to a risk-priced micro-region where premium buyers demand quantifiable risk mitigation and discount heavily if it is absent. The valuation ceiling is compressing, and previously liquid homes are now illiquid assets. 9. Beverly Hills, high-end liquidity freeze. Beverly Hills is among the most globally recognized luxury brands in residential real estate. Historically, brand identity alone created a price floor. That floor has cracked. Observed market behavior homes once purchased at $5 to $7 million are testing the $3 to $4 million range. Liquidity at the top end is evaporating despite reduced ask prices. Ownership costs have reached levels that materially affect demand. Structural cost breakdown, property taxes on homes above $3 million routinely exceed $30,000 annually. Energy, security, staff, and maintenance contribute another $20,000 to $60,000 per year. Renovation activity is constrained by highly restrictive permitting, increasing both cost and timeline. Negative income strategy shift. Previously, luxury properties could be partially subsidized through short-term rental activity. Increased restrictions and taxation have eliminated that strategy for many owners, converting these homes into pure liabilities rather than hybrid assets. Market conclusion. Beverly Hills still carries global prestige, but the intersection of high ownership costs, insurance challenges, regulatory friction, and shifting buyer demographics has generated a valuation slowdown that did not exist in prior market cycles. 8. Malibu, the climate risk case study. Malibu is now the national case study for luxury markets, exposed to climate-accelerated risk. Prices are no longer tied to aesthetics. They are tied to slope stability, surfline encroachment, erosion patterns, and insurability. Key data homes previously listed at 7 emlets now reposition around 3.5 tak or 4.5 mit. Days on market exceed prior records. Insurance carriers are withdrawing entirely from specific zip codes. Physical risk profile. Oceanfront homes have lost measurable land to erosion. Winter storm surges have accelerated bluff deterioration. Wildfire seasons have expanded from 3 months to 7 months annually. Insurance impact premiums can exceed $50,000 to $100,000 yearly if coverage is available at all. Many policies now require specialized fire mitigation, structural reinforcement, high deductibles, mandatory hardening of the home. In some areas, replacement cost coverage is restricted, creating exposures that effectively eliminate mortgage eligibility. Investment Assessment Malibu has transitioned from a luxury market to a risk-adjusted asset class, similar to coastal infrastructure. Values now hinge on resilience engineering, not aesthetics or branding. 7. San Francisco, the urban high-end correction. San Francisco's luxury market once operated under the assumption of infinite demand driven by technology employment, IPO liquidity, and global investment. That assumption has broken. Drivers of decline: remote work, redistribution, crime and safety concerns in commercial corridors, insurance increases tied to wildfire and earthquake modeling, deterioration of municipal conditions, regulatory burdens that impede renovation. Market effects: homes that sold above 2.5 meters are listed under 1.2 to 1.4 hours. Price discovery remains volatile due to buyer hesitancy. Multifamily and historic homes face particularly sharp discounting. Renovation risk: San Francisco's regulatory environment is one of the most complex in the U.S. Permits can take 6 to 24 months for minor projects, 24 to 48 months for structural modifications. This delays value-add strategies and reduces investor participation. Conclusion: San Francisco is no longer a guaranteed appreciation market. It is becoming a high-risk, high-regulation, low-liquidity luxury segment that requires deep local expertise and substantial capital reserves. 6. Napa, the water and wildfire. Double squeeze. Napa's luxury market is fundamentally tied to land, water, and fire. All three are under pressure. Current conditions: estate homes above $2 million are repriced downward but still struggle for liquidity. Fire maps classify large regions as high threat. Wells, vineyards, and septic systems require increased testing and maintenance. Core risks: water scarcity is forcing wineries to truck in water at enormous cost. Insurance premiums reflect catastrophic loss potential. Rural infrastructure, roads, utilities, bridges, is expensive to maintain. Investment conclusion: Napa luxury real estate now behaves more like a resource-dependent asset than a traditional residential holding. Its value is tightly tethered to environmental stability, which is becoming more volatile. 5. Santa Barbara, flood risk. Repricing. Santa Barbara's luxury appeal remains intact on the surface, but flood and debris flow events have meaningfully changed its underwriting conditions. Risk dynamics: high-end homes above 2.5 meters show multi-year price stagnation or decline. Updated flood maps push more buyers into mandatory coverage. Recharge basins, slope stability, and watershed management have become central valuation factors. Insurance pressure: coastal insurers have increased premiums or reduced exposure. In certain zip codes, coverage is only available through a patchwork of flood policies, fair plan fire policies, high deductible supplemental policies. Conclusion. Santa Barbara, luxury real estate must now be evaluated through hydrological and geotechnical risk, not simply aesthetics or location. 4. Laguna Beach, slope instability as a valuation driver. Laguna Beach is one of California's most topographically vulnerable markets. Market conditions. Luxury homes, 3M plus, face long selling cycles. Price reductions are increasingly common. Slope failures have red-tagged multiple homes in recent years. Insurance constraints. Many policies exclude earth movement, landslide, slope failure, soil instability. This shifts risk directly onto the owner, compressing valuations and shrinking lender participation. Local government challenges. Mitigation often requires retaining walls, drainage modification, engineering studies, geological assessments. These add ongoing costs and reduce buyer appetite. Investment conclusion. Laguna Beach is now a geotechnical risk market, and valuations will increasingly reflect that reality. 3. Palo Alto, tech sector exposure. Palo Alto was historically the epicenter of demand elasticity for Silicon Valley. That elasticity is now impaired. Why the market is softening. Tech layoffs reduce purchaser pool. Remote work decreases need to live near campuses, property taxes and insurance squeeze affordability. Aging homes require major reinvestment. Valuation data. Homes previously selling above $4 million require significant reductions. Liquidity is weaker for older homes lacking modernization. Buyer selection is increasingly cautious and data-driven. Structural conclusion. The luxury market in Palo Alto is transitioning from tech-fueled appreciation to income-to-risk-constrained valuation. 2. Palos Verdes, the overlooked high-risk peninsula. Palos Verdes has long benefited from its ocean views and school districts, but underlying risks are rising. Risk factors: coastal erosion, earthquake exposure, slope instability, insurance volatility, market behaviors. Homes above 3 million face longer absorption times. Coastal permits are slow and costly. Buyers heavily discount for geotechnical risk. Conclusion. Palos Verdes is becoming another risk-adjusted coastal market where demand remains but pricing power erodes. 1. Greater Los Angeles, idle inventory at scale. Los Angeles County contains some of the most diverse luxury submarkets in the U.S., but many are now showing uniform symptoms of a structural correction. Macro conditions. 3 Tier 5 Malibu homes are testing lower valuation bands. Some sit 200-plus days without offers. Crime, insurance, and infrastructure costs reshape buyer calculations. Risk drivers. Fire risk in canyons, aging sewer and pipeline infrastructure. HOA special assessments, insurance non-renewals, regulatory and permitting delays. Climate-related hazard zones expanding. Market outlook. LA luxury real estate is now bifurcating. High-quality, low-risk homes remain desirable. High-risk, high-cost homes face steep repricing. The days of indiscriminate appreciation are over. Final analysis. What this means for investors. The California luxury market no longer behaves like a scarcity-driven asset. It behaves like a risk-priced market with increasing volatility and rising ownership costs. Key takeaways. Price declines of 25–50% do not automatically indicate value. Insurance is the new gatekeeper of liquidity. Climate risk is not future, it's present, and lenders know it. High carrying costs create long-term drag on returns. Regulatory friction reduces the viability of renovation-driven value creation. Liquidity is no longer guaranteed at the top of the market. Investment positioning strategy. Avoid high-risk geographies with weakening insurance availability. Focus on inland markets with strong employment bases and stable risk profiles. Only acquire luxury assets with quantifiable resilience features. Account for 10 to 20-year carrying cost trajectories, especially insurance. Target sellers facing time pressure, insurance non-renewals, or regulatory burdens. Closing California, luxury real estate is entering a multi-year repricing cycle driven not by temporary sentiment but by permanent structural factors. For informed investors, this period presents opportunity, but only with disciplined underwriting, risk-adjusted modeling, and a clear understanding of the new California cost structure.